If you're thinking about closing your limited company and it still owes money, be careful. Because if you get it wrong, it could come back to bite you personally. And that could be HMRC, bailiffs, even legal action, months after you think that it's all over. Every single week we speak to UK directors who thought they'd closed the door, only for that door to get kicked open again somewhere down the line. And it's all because they used the wrong method. They might have struck off the company incorrectly, or they didn't deal with the company debt properly. And in this video, I'm going to explain exactly how you shut down a limited company that owes money, what your exact options are, and how to avoid personal risk, and what to do right now if you're in this position. So hit subscribe if you want some straight answers on UK insolvency, and stay to the end for a step-by-step plan that you can follow today. I'm Chris Worden, I'm from Director First, and I help directors who are in trouble financially. And that's whether they've got debt to HMRC or other creditors, or they just need to close the doors and move on. I've seen what happens when directors get it wrong, and I have helped thousands of directors over the years get it right. And this video is going to break down what it actually means to close a company with debt, the different options that you need to know, the big mistakes that get directors in trouble, some real life examples, and a clear 30-day action plan for you to take. So if you're stressed, overwhelmed, or you just don't know where to start, stay with me, because this could be the turning point. Right. I want to clear up a common myth right away, okay? You can't just shut down a company and hope debt disappears. If you do it properly, there is a legal process. If you skip the legal process, that's where you could end up personally paying the price. And here's the difference between closing a company properly and causing yourself some serious problems. Proper closure means using a legal process like an administration or a liquidation. And in that process, all the creditors of the company are treated fairly. Improper closure, let's talk about the most common one at the moment, is trying to strike a company off when you owe a bounce back loan, or trying to strike a company off when you owe HMRC significant amounts of money, or selling your company that's got a shed load of debt to someone else for £1. Oh, and by the way, you've got to pay them £5,000 for them to buy your company for £1. Listen, if it's too good to be true, it generally is, okay? So I want to give you a real life example. So I had a client, well, they weren't a client, I had a director who called me. He wanted to know what his options were. He owed HMRC, he owed suppliers, and he owed the bounce back loan. And I said, listen, based on what you've told me, really the only option for this business is going to be a liquidation. And I'd spotted there was an overdrawn loan account, and obviously I've just gone through it all. That's what I do here, is I'll let you know everything. Literally, you'll know everything, how much things are going to cost you before I ask you for a penny, okay? And in total, this guy was going to pay £5,000 to liquidate, and he was going to have to pay about £15,000 on his director's loan account. And he had another company who said for £2,000 they would get his company struck off the register. And he had another company that said, listen, if you pay us £5,000, we will buy your company off him. And obviously two of those options, you know, one's costing £2,000, one's costing £5,000, mine's costing close to £20,000. And the guy buried his head in the sands, and listen, he's ended up getting wound up, and the official receiver's been on to him. They want all the overdrawn loan account back. And he got back in touch with me. I said, John, I can't help you, mate. I says, I've given you the information, you've not took it. You've heard the old saying, you can take a horse to water, but whether that water sticks its mouth in and has a drink is not up to me. But the reality is if you get this wrong, there can be huge, huge consequences for you personally. I want to address striking off companies, okay? Voluntary dissolution. And it's a process where a director applies to have their company removed from Companies House, the register. And it's quick, it's cheap, feels like a clean break. I think it's 33 quid now to strike off a company. But here's the problem. It's only legal if the company has no outstanding debts. In addition to that, you can't have been trading for 3 months. You can't have changed the name recently. And it shouldn't be subject to any legal action. Most importantly, you can't strike a company off that still owes a bounce back loan. And you're not really meant to strike a company off that owes money to HMRC, suppliers, landlords or staff. And what this means is it applies to very few businesses that are in debt, but it will be sold as a solution to people. Now, if you strike a company off and it still owes money, the problems are your creditors can and will object to the strike off. So what happens when you file a DSO1 form, you put it into Companies House, and Companies House will put something on the London Gazette. Now, the creditors of your company will highly likely have little tracks on your company. They might use red flag or credit fix, so credit safe. And if anything changes in the status of your company, that's public available information, which strike off will be, that bank will get notified that you've tried to strike it off and they will raise an objection. Same with HMRC. Now, go back a bit. Let's talk about bounce back loans and striking companies off. If you try and strike the company off now with a bounce back loan, the bank will object, you'll just be in limbo. But go back a few years, there were people who thought they were being really clever, who took bounce back loans, whipped it all out of the company, and then went to strike the company off at Companies House, thinking that they would circumnavigate any investigation. Listen, these are the girls and boys who've gone to prison. Like, it was that serious. Listen, even if you get a strike off that goes through, the company can still be reinstated by any of the creditors. It's highly unlikely for small debts, but listen, it's possible. So yeah, the reality is the strike off can be undone. Now, what I want to talk to you about finally with strike offs, right? If you have a company that has some debt, you owe HMRC 5 grand, 10 grand, you owe some suppliers a little bit of money, but you don't have a bounce back loan or a C-bills. And let's say that you've gone to a insolvency professional and you cannot afford the 5 grand to liquidate. You've deregistered for that, you've not been trading for 3 months. What you might try is you may try the strike-off method, but what you must do is write to your creditors to tell them that is what you're planning on doing. So it's almost a letter to HMRC saying, I'm about to strike the company off. Here is the copy of the DSO1 form. I know I owe you some money, but my company has no cash, it has no assets, and I can't afford a liquidator's fees. And you almost invite them and say, if you want to, you can wind me up. And if the business doesn't have any cash or any assets and the debt levels, I think sort of less than 20 grand, I think it's highly likely HMRC will allow the strike off to happen. They may object on the first instance and you would just refile that DSO1 form. And once they look at it, it's like we're not going to spend money chasing this company that has nothing, okay? Now, if you're going to use that method, you must write to your creditors to let them know. And I'm going to finish on this one. A strike-off is really only appropriate. There's only really one time when a strike-off is appropriate. And it's when the company's got no debts. You paid all the taxes, you paid all the creditors, there is no ongoing trading or legal issues, and you've properly withdrawn any remaining funds. And if that's your situation, fine. You filed the DSO1 form, close the bank account, notify stakeholders, and you dissolve the company legally. But if your company owes anything, and especially if it owes a bounce back loan or receivables, then strike off is not only risky, it could actually cause you a problem personally. So option 2 is creditors, voluntary liquidation, and this is the most common form of company closure. And I'm going to call it liquidation for short, voluntary liquidation. Now, this is what you should be doing if your company is insolvent, okay? Now let me just reaffirm what insolvency is. There's a test, the corporate insolvency test. And the first test is a cash flow test. Can you pay your debts as and when they fall due? So if you're on a time to pay arrangement with HMRC, you're insolvent on a cash flow basis. If you are robbing Peter to pay Paul every month, shows that you're insolvent on a cash flow basis. And there's a balance sheet test, and that's when you total up all your assets, so stock, materials, vehicles, cash in the bank, cash owed in, and you compare that to what you owe out. And if your liabilities are more than your assets, you're also insolvent on a balance sheet basis. And there's also a legal action test. And a legal action test is if somebody's got a CCJ against you, obviously you're insolvent on a legal action basis as well. So when you're insolvent and you've got no hope of recovery, that's important. So you've got no reasonable hope that you're going to get back to profitability, you need to look at insolvency options. And a liquidation is a formal insolvency procedure where you voluntarily close your limited company and you bring in a licensed insolvency practitioner to do it properly. And they handle notifying creditors, selling any company assets if there are any, dealing with staff redundancies, and they're going to investigate the conduct of the director. And they're going to report to creditors, HMRC and the Insolvency Service. Now, it can sound scary, but it's the process that actually protects you as a director when your company can't pay its debts. Now, it's really important for me that you always do it voluntarily as opposed to compulsory, which I'll come to a little bit later. Now, these are the things that happen when you go into liquidation. Okay. First thing is you speak to somebody. Speak to more than one person. Somebody like us. But if you don't like us, go and find someone else decent and do your due diligence, right? Make sure you check people's reviews out. And if a liquidation is the right fit, they will bring a licensed insolvency practitioner, and that licensed insolvency practitioner is appointed. You have to sign, you have to give quite a bit of information. There's a shopping list, pass anti-money laundering, and then the notices will go out for you to sign and you will send them back. So you can stop trading and your creditors are then notified. Once the creditors are notified, including the bank, your bank account is frozen. And at the creditors meeting, the insolvency practitioner is appointed, generally 14 to 21 days after you sign your notices. And they will handle things like selling assets, and if any money comes in, they'll pay creditors based on their hierarchy in the creditors list. Then they're going to investigate your conduct as a director. Okay, they're going to look at what you spent money on. They're going to look for if you've taken big sums of money out of the account. They're going to look at whether you've sold assets in the business for less than they're worth. And they're going to report that to the Insolvency Service, and there will be reports on Companies House for about 12 months. And then the idea is the company gets dissolved, okay? Once you appoint a liquidator, you're no longer being chased for company debts, certainly unsecured company debts, because they're written off inside the liquidation, okay? Unless you've done something wrong, and we're going to cover that soon, okay? Now, for me, a CVL liquidation is the safest way to shut your company down with that, because it shows that you're acting appropriately, okay? You're insolvent, okay? That's not a crime. But once you become insolvent, your duty as a director is not to make the creditors' positions any worse. So you choose to act before one of your creditors force the issue. And it stops legal threats. Once the process starts, creditors can't take action against you. Things like bounce back loans are written off. C-bills loans, certainly under 250,000, are written off as long as they're used appropriately. Your staff, this is important, once you've gone into liquidation, your staff can claim redundancy. And even directors, if they were on the payroll and they don't have an overdrawn loan account and they're not planning on setting up a similar company, could claim redundancy from the government, okay? And you've protected, okay, if you do this, from future creditor claims if the process is handled correctly, okay? I want to talk to you now about what the insolvency practitioner is going to look for, okay? Because they're legally required to investigate things like overdrawn directors' loan accounts, preference payments, which is paying one creditor over another, assets transferred before liquidation, and bounce back loan misuse, and things like, you know, any sign of wrongful trading. So it's crucial that you are honest from the start and you get advice early, okay? Because most processes, most issues can be managed if they're dealt with proactively, but become serious if you try and hide them. Listen, let's dive up to overdrawn loan accounts, okay? These are, without doubt, the #1 problem for directors today. Now, every director has a ledger in their company that's called a director's loan. And when you put money in, it goes as a credit on your director's loan. When you take money out, it goes as a debit on your director's loan. And quite simply, it's just a running tally of this money in and money out of the company to the directors. Now, here's the problem. We are told, I'm told the same, I take out a 12 grand a year salary out of this business through the payroll, and I top it up with drawings every month in anticipation of a profit at the end of the year. The reason why I know I'm making a profit is I have monthly management accounts that shows me if I'm making money or not. Most directors don't know this and they don't look at this. And what, let's say for argument's sake, you're taking £1 grand a month salary and you are taking another £4 grand a month, in your head you're calling it a dividend, right? But you owe HMRC and you have not paid your last 4 VAT quarters or your last 2 corporation tax. At the end of the year, that money that you've taken over and above the salary is going to be an illegal dividend. And it's not illegal that you're going to prison, but it's illegal in the sense that your company has no profits. It's insolvent because it can't pay its debts to HMRC. So that other 4 grand a month that you've taken over the course of the year, another 48 grand, it's going to get reclassified to a director's loan account that's overdrawn. Or let's say you don't even have those accounts done and you come to a liquidator and the liquidator reviews your last 12 months, and that's what's happened. You've been insolvent for 18 months, last 12 months you've took 48 grand out of your business. They're going to convert that 48 grand to a director's loan account that's overdrawn, and they're going to pursue you for it, okay? They're going to ask you to pay that 48 grand back a few weeks after you've gone into liquidation with them. It's a huge, huge, huge problem, and a problem that most of you do not know about. It's not the 5 grand that hurts when you go into liquidation. It's the 50 grand you are getting chased for 3 weeks after you liquidate. Now, what is the solution to this? Okay, a good solution is, once you become insolvent, once you are struggling to pay your debts, once you are robbing Peter to pay Paul, and you see your revenues are going down, consider changing how you pay yourself and going from taking a combination of salary and dividends to just salary. Perhaps increase your salary. That's going to cost more at source because you're going to have a PAYE bill, but it's going to protect you in the long run because you're not going to have an overdrawn loan account, or you'll minimise your overdrawn loan account. But for those out there thinking, Chris, you've really worried me now, how do I know if I've got an overdrawn loan? The first thing you want to check is your management information. Like, do you run Xero, QuickBooks, Sage? Pull off a balance sheet. That balance sheet, if it's up to date, will have a line in assets or debtors for what a director's current account will be, or it might be called director's loan, it might be called director's advances and credits. That is if you have up-to-date management information. For those of you that don't, It's a little bit harder. You go to your last set of accounts. Your last set of accounts will have in there, in the assets section, or the debtors section, or the directors advances section, it will have a line about your director's loan account, whether it's in credit or in debit. If it's in debit, that means that you owe the company money. So if you owe the company money at your last set of accounts, and you've continued to take your money out in the manner I've just mentioned, excuse me, sort of 12 grand a year as salary, the rest you're taking out in your head as dividends, everything that you've taken out of that account since those last set of accounts could end up being converted to an overdrawn director's loan account. Okay, so what I'd suggest actually, if I'm worrying you, you need to pick the phone up right away, because these issues, if they're left unattended, most firms don't talk about it. They purposefully, they'll say things like, we'll deal with it once you've appointed us. You've heard me say this 100 times before. Appointing an insolvency practitioner is like dancing with a gorilla. The dance is over when the gorilla says it's over, not when you say it's over. Okay? This is something you need to understand before you make a decision. Okay? If you're working with us at Director First, listen, we'll do all this for free. We will not charge you for it. We'll give you all this value so you understand what your director's loan account issue is, and we'll actually help you understand how you can mitigate against it. We won't ask for a penny. Now, if you've got an overdrawn loan account, it's really, really important that you speak to the insolvency practitioner about this beforehand. You bring it up and you sort of show them what you think it is, because an insolvency practitioner has the discretion to offer discounts on overdrawn loan accounts. They can't do it before you've appointed them, but you can have a proactive conversation about it up front. And it essentially is that insolvency practitioner has got to get a better realisation off you on that director's loan account than they would if they took legal action against you and ultimately made you bankrupt. So I want to talk about bankruptcy. It's not to scare you, it's to put you in a position of power. People don't really understand bankruptcy, but let's say you have got a house. I don't know, I'm going to pick a, let me just get one up on my, here we go. I've got one that I've dealt with recently. So this guy had a director's loan account of, I think it was £70,000. Yeah, £70,000. And he owned a house. He owned a house of 400,000, and his mortgage was 200,000. And you're probably thinking, oh my God, he's going to be in a lot of trouble there. And you're right, you know, it's a scary thing. He owes the company £70,000. He's got a house that's worth 400 grand and his mortgage is only 200 grand, okay? But in a bankruptcy scenario, that house would be sold on a for sale value, so probably 90% of what it's really worth. So now it's worth 360,000 and his mortgage on it is 200,000, okay? So you're thinking, okay, in that scenario, he's probably got about 160 grand equity, right? So now we've got to factor into other costs. It's going to cost, say, 1% to sell, so 4 grand to sell, 3,600 to actually do the conveyancing, and then we've got in there all the costs of making someone bankrupt, and that's petitioning cost of a couple of grand, official receivers cost of 6 grand plus that. Then you've got the trustee in bankruptcy's cost of 15% of realisations. That could be more. And then you've got solicitors' fees. Well, could cost 20 grand, 25 grand to get someone to bankruptcy years down the line. And we're sort of now talking that it's probably going to cost about 50 grand to make this guy bankrupt. Oh, and his wife has got a claim on the house, she's on the mortgage. So as you can see from this, once you factor in that half the equity is his wife's, and his wife has nothing to do with the business, therefore the insolvency practitioner can't touch her equity. And the fact that it's going to cost 50 grand to make it bankrupt, this guy is in a good position to get a settlement done. Oh, and also he owes about £140,000 in personal debt. Because in his liquidation, he borrowed money off Funding Circle, IWOC and Capital on Tap. And all those debts are going to crystallise at the creditors meeting, and they're going to all chase him personally. So this guy is going to offer a very token payment to the insolvency practitioner, and I don't mind sharing it with you. He offered £5,000 paid over 5 months, and it got accepted because that is a better realisation than the insolvency practitioner would get if they went down the legal route. Okay. Now, that doesn't happen with everybody. It happens here at Director First because we do a lot of work to help you get the best deal. We can't break any rules, we don't hide anything, we have honest, upfront conversations with you and the insolvency practitioners that we work with, okay? Now another caveat is the insolvency practitioner cannot formally accept this deal from you until they've been appointed. So at this stage it's all done in principle and we're relying on you telling us the truth. Obviously once the insolvency practitioner is appointed, they are going to have to investigate and they're going to look at things like mortgage statements, valuations, income and expenditures. But director's loan account, it is a problem. I'll give you some good information there to help you navigate it. Another problem is preference payments, okay? What that means is paying one creditor ahead of others. So paying off your Auntie Mildred 2 weeks before you liquidate 50 grand that she's lent you. You've got to be careful. You've got to treat all creditors equally. So the minute that you speak to an insolvency practitioner and you're going down this route, any payments that you're considering making out of that business, you need to speak to them about it, okay? Another thing is when you transfer assets before liquidation, this is what they're going to be looking at. Now you can transfer assets from your business to someone else, to you personally, or to another company that's connected to you just before you liquidate. But you've got to pay a fair value for these assets. Really, really important. And a fair value, if you think about cars or vans, you can go on WeBuyAnyCar.com, you can go on WeBuyAnyVan.com, and you type in your details and they'll tell you what that value is, okay? What I would always suggest is you get an agent to do a valuation on vehicles, on plant, on machinery, and an agent will put together a third-party report for you. It might cost you 500 quid, £1,000. But if you're thinking of transferring assets out of the company, it's money well spent. Because they will put in there what they believe that the in-situ value is, so what they believe they're really worth to you, and something called ex-situ value. And ex-situ means to come and remove goods from your premises and sell them at auction or to a stock buyer. And you will be surprised at what that figure comes out at, because you've got auctioneers' fees, you've got agents' fees, you've got storage fees, and then you're relying on somebody buying something at auction. Now, if you get a valuation done, let's say in situ is 30 grand, ex situ is 5 grand. As long as you are paying for these assets closer to the in situ value, you can't be criticised by the insolvency practitioner or any creditors once you're in liquidation. Okay? Again, if you're thinking of doing this, pick the phone up, we'll help, we'll advise you, we'll guide you for free so you don't make any mistakes. Another big thing that insolvency practitioners are looking at for at the moment is bounce back loan misuse. Okay? Really, really hot topic right now. So for those that don't know, okay, a bounce back loan was given out by the government in 2020 and it was for people that were trading in January 2020 who've been negatively affected by COVID. If you weren't trading, you weren't allowed a bounce back loan. You could only apply for 25% of your turnover in 2019, capped at 50%, capped at 50 grand. So if your turnover in 19 was 100 grand, you could apply for 25 grand. It's only if it was over 200 grand could you apply for 50. And if you are estimating your turnover, you had to have been incorporated in only 2019, okay? It's really important that you spent the money on the business that took the loan. If you took the loan and then funneled it to other companies connected that weren't part of the company that took it, that is going to constitute a problem. And that is the type of thing that gets reported to the Insolvency Service. We see lots of disqualifications. We're seeing lots of compensation orders being made, which means you become liable of the bounce back loan. Okay? Now, what does all this cost? Listen, general liquidation is going to cost around £5,000, okay? Depending on the complexity. But here's the thing, it's not always the only cost. You know, in addition, you might be paying for assets. You might be having to pay back a director's loan account, or you might be having to pay a settlement on a director's loan. So it's important before you make a decision with any firm is you get all this stuff in writing. Now, how you can pay for liquidation fees is fairly easy. If you've got cash in the bank, it can be paid from remaining company funds, or sometimes the money can be paid from the assets that have been recovered by the insolvency practitioner, okay? So signs that like liquidation is right for you is, let's say you're HMRC, supplier, staff, bounce back loan, you can't make ends meet, okay? You can't see a route to pay them off. You've stopped trading or you want to stop, okay? You know that you're not going to make any hope of recovery. If you know that, that's where a liquidation is a really good option, okay? Another option is a CVA, company voluntary arrangement, okay? So let's say your business is in trouble, but you still believe it could recover. You've got contracts, you've got cash flow coming in, just not yet, you've got loyal customers, you've got assets that need protecting, you might have accreditations like CQC or no license if you're a haulier, and in that case you might not want to shut down at all, and instead a company voluntary arrangement could be the right move. It's a formal agreement between your company and its creditors, and you propose a plan to repay all or part of your debts over a set period, generally 3 to 5 years, and it's based on what the company can realistically afford. Now, hopefully you get your creditors to vote in favour, because you need 75% approval by debt value, and then the CVA becomes legally binding. And there's lots of benefits to CVAs. You know, you stay in business, you pay what you can afford, not the full debt in most cases. Legal action stopped, including that from HMRC. You avoid a liquidation process, and you maintain control as a director. Now, for many directors who are fighting to save a viable company, this is a lifeline, okay? And when they work best is when you've got strong projected income in the future, okay? You're committed to trading long term. You've got a decent relationship with creditors, and you act before enforcement action or a winding up petition begins, okay? Another option I want to talk to you is administration, okay? And what we call a pre-pack sale. This is a powerful option, but only in the right situation. Now, an administration is when an insolvency practitioner takes over a company temporarily, putting it into legal protection to stop creditor action while options are being reviewed, okay? Now, saving the company isn't viable, the business and the assets may be sold to get some money for creditors, but a lot of the time, before the company goes into administration, a new company is set up by the original director, and this is called a pre-pack. And what happens is, your business is valued by an agent. There is a marketing period where the agent invites offers from the public to buy the business, so it's fair. And at the end of that marketing period, you as the director get the opportunity to put an offer into the agent to buy the business back. If the agent accepts the offer, it's then handed over to a solicitor and a sale and purchase agreement is done, and you buy the business pre-packed. Then the company goes into the administration, and the administrator is appointed to conduct their investigations. And why you might choose administration is things like when you're under serious creditor pressure, you've got legal threats, you need some breathing space to sort of get some value. You want to preserve contracts, licenses, you want to keep staff employed, your brand might have some value, and you're trying to avoid a fire sale of the assets. So we've involved in many administrations over the years, but it is more expensive. You know, there's legal costs, there's agents costs, you know. Pre-packs are also legally sensitive. You know, they've got to be handled properly. You'll need independent valuations. You've got to pay a fair price. You're going to need to get approval from an independent adjudicator. And it's often used in businesses that are a little bit more complex. But again, if you're considering administration, you've got to pick the phone up, Okay, talk through your options. Now the worst option, sadly lots of people do this, is they do nothing. And I want to be brutally honest with you. The worst decision you can make as a director is do nothing. Waiting, hoping, avoiding letters and ignoring phone calls. It feels easier in the moment. But listen, it causes more damage, more than any other option. And I know, because I've been there. Listen, I have been there, not answering the phone, not wanting to open brown paper envelopes. Because I have been a guy who's been a massive advocate of personal development all my life and positive thinking. This is an issue when your business is hitting the skids, okay? Tony Robbins once said, I can look out the window and say, I've got no weeds, I've got no weeds, I've got no weeds. And what's going to happen is your garden is going to get overgrown with weeds. I've got to understand things as they are, not worse than they are, and then I've got to take action to solve them. Now, if you don't do anything, HMRC or another creditor will issue a winding up petition, and this is where it's a compulsory liquidation. They go to court, you get a winding up petition on your desk, 2 weeks later it's generally advertised, your bank account's frozen, and you get investigated by the official receiver. And the first thing they're going to say is you are not fit to be a director because you had the opportunity to do this voluntarily some time ago and you buried your head in the sand. Okay? Dead important that you take action. The consequences of being wound up are always worse than doing this voluntarily. Okay? So, here's the step-by-step director first checklist, if you're still watching. First of all, if you're insolvent, stop making big personal withdrawals immediately, okay? If you're going to take money out of the business, you need to start changing the way you're paying yourself. Speak to your accountant, okay? And go from a combination of salary and dividends to all salary, okay? If the business is insolvent, stop paying the credit card from the company, okay? Stop taking money out of this business if you are insolvent. It could be classed as misfeasance and come back to bite you later. Number 2, do a quick insolvency test. Can you pay bills on time, okay? Are you on a time to pay arrangement, HMRC? Are your liabilities more than your assets? And if the answer is yes to either, you're insolvent and you now have a legal duty to act in the best interest of creditors. Number 3, get some up-to-date information. Pull together like your management information, your profit and loss, your balance sheet. You know, let's have a look at that. Let's have a look at that age creditor list. Let's have a look at absolutely who you owe money to, okay? This is going to help you have a easier conversation with a professional insolvency person, okay? Number 4, please don't strike the company off. If you've got unpaid creditors, especially HMRC or bounce back loan, do not dissolve the company. Please do not try and sell the company where you have to pay some firm £5,000. I mean, think about it. I'm going to buy your company for £1, but you've got to pay me £5,000. It's nonsense, isn't it? Okay? You've got to do the right thing. You've got to take professional advice, okay? So, if anything I have said has resonated with you today, okay, give me a call. If you're in that place, overwhelmed, unsure what to do, don't go alone. Subscribe to the channel for more plain English breakdowns like this. Drop a comment if you've got a question, I'll reply, or book a free confidential call with Director First. We're not here to judge, we're here to protect you and help you move forward. Thank you for your time. God bless you.